Good evening, ladies and gentlemen, and welcome to 361 WAM earnings call for Q1 FY26. As a reminder, all participant lines will be in listen-only mode. In case you wish to ask questions or require assistance during the conference, kindly signal the host by tapping on the raise hand icon. Please note, this conference is being recorded. On the call today, we have with us Mr. Karan Bhagat, Managing Director and CEO, Mr. Yatin Shah, CEO of the Wealth Business, Mr. Anshuman Maheshwari, COO, and Mr. Sanjay Wadhwa, CFO. I now hand it over to Mr. Sanjay Wadhwa to take this conference ahead. Thank you.
Thank you, Anil, and a very good evening to all the participants. Starting with the macros, Indian equities, after facing some sharp volatilities in the last 2 quarters, witnessed a rebound in Q1 FY26. While geopolitical events could influence broader markets in the near term, structurally, we continue to remain bullish about India's long-term growth story, which will act as a tailwind for India's wealth and asset management sector. Before I get into the business and financial numbers, just wanted to highlight that the consolidated financials for the quarter include full quarter financials of ET Money and post-acquisition financials of just over a month for BNK. Our total ARR AUM increased to 2,87,317 crores, up 30% year-on-year. This growth was supported by strong net flows at 20,950 crores. The flows also include ARR net flows of 18,266 crore as a result of the acquisition of BNK Securities. The growth in our client base continued to be very healthy. Presently, we have 4,200 clients with a total AUM of 10 crore plus, who account for 95% of wealth AUM, excluding custody. This includes approximately 700 corporate clients that we have onboarded as part of the BNK transaction. Our ARR revenue for the quarter grew 35.9% year-on-year at 511 crores, led by strong growth in assets across business segments. Our ARR revenue as a percentage of total revenue from operations stood at 77%. Retention of ARR AUM also remains strong at 79 basis points and 70 basis points ex of carry. Total revenues stood at 725 crores for Q1 FY26, driven by higher ARR revenue and other income. Total costs are up 32.7% YOY to 351 crores in Q1 FY26. The cost to income ratio stands at 48.4% as compared to 50.7% in Q4 FY25. As explained earlier, the cost for the quarter also include full quarter cost of ET Money and post-acquisition cost of BNK. We expect gradual improvement in this metric over the coming quarters as we scale up and drive synergies from new business initiatives and teams. We are very happy to report that the company recorded its highest ever quarterly PAT at 287 crores, an increase of 18% year-on-year. The tangible ROE is at 19.6% in Q1 FY26. This ratio is expected to improve in the coming quarters as additional capital deployed in our lending and alternate businesses in FY25 begin to reflect in earnings. With that, I would like to hand over to Anshuman to cover key business and strategic highlights.
Thanks, Sanjay, and good evening, everyone. Taking Sanjay's comments on the overall business numbers ahead, I would like to share updates on our key strategic initiatives. As you are aware, in recent quarters, we undertook inorganic measures to strengthen our core business model as well as create future optionality. These initiatives are expected to enhance our core tenets and help us benefit from the significant wealth and asset market opportunity in India. Firstly, on BNK, we are happy to announce that the deal has been successfully consummated and all requisite approvals were received on May 27, 2025. Post-merger integration of people and processes has already begun. Mr. Sahil Murarka, promoter and MD of BNK Securities, has joined the 361 leadership and will continue to spearhead the business along with Mr. Sanjeev Mohta and the high caliber team at BNK. We are also excited as Sahil joins the 361 WAM board. With BNK, we are now better positioned to build out a robust, sustainable broking and transactional platform within our wealth management franchise. Secondly, our conviction on the HNI business continues to grow. With over 30 RMs, 250 clients, and 1,500 crores of AUM tracking at over 90 bips of retention, we are now well poised to drive the scaling up and see that happen over the next few quarters. While 360 ONE's broader platform and core client-centric wealth management ethos will continue to effectively support the growth of the HNI business, we are also excited to take numerous technology-related developments done for this segment to our UHNI clients as well as our core senior bankers. Thirdly, on our strategic collaboration with UBS, we are happy to share that we have received all regulatory approvals to complete the transaction. As shared earlier, the strategic collaboration has three interrelated components: business collaboration across geographies and business segment, UBS stake in 360 ONE, and integration of UBS India's wealth management business with 360 ONE WAM. As we speak, supported by the top management from both firms, we are working towards a smooth migration and integration while creating expressways globally for a strong international collaboration. This collaboration brings together two powerhouses in the space of wealth management to create a platform that is truly without parallel in the country. This exclusivity, it guides not just by the business opportunity, but also by shared beliefs in values, ambition, and a client-first philosophy. UBS's global investment expertise, research, and access will improve our ability to serve the cross-border needs of our clients, as well as enhance our wealth management proposition further. Fourthly, on ET Money, with the firm becoming part of 360 ONE WAM, we have jointly laid out an exciting strategic agenda to go deep into the mass affluent segment and drive growth and higher monetization of the rapidly expanding client base. We will continue to share more on ET Money as we go through the next few quarters. On the asset management front, the continued focus on deepening our channel presence in the domestic market, specifically through MFDs, is delivering positive results. The pipeline of new funds across asset classes, as well as new international institutional mandate pipeline, remains strong. Global institutions continue to be interested in exploring new investment strategies with us, driven by the India growth story, and our ability to innovate and co-create strategies with them. Such tailwinds, supported by 360 ONE Assets' strong track record in managing prestigious institutional clients, gives us confidence towards the next phase of growth for the business. Also, we plan to extend our alternate strategies to a larger set of client base, as well as institutional clients across India as well as globally in the coming quarters. I think apart from the core business areas, we continue to take exceptional pride in the external recognition received by our wealth and asset management businesses. We continue to be very proud of the awards received in the last quarter and over the last few years. We are also very proud to be recognized as a Great Place to Work 2025. I would take this opportunity to thank all our partners and stakeholders who have bestowed this trust and confidence in us through our journey. With that, I'd like to hand it over to Karan and Yatin for Q&A.
Thank you, Anshuman. To ask your question, we request you to kindly signal on the raise hand icon. First in line, we have Mohit Mangal. Kindly unmute and ask your question. Mohit? Yeah. Mohit, can you hear us? I invite Lalit Dio.
Am I audible?
Yes.
Yeah, can I go ahead?
Yeah, go ahead.
Yeah. So my first question is on net flows. So basically, you have mentioned in your presentation that about 18,000 crores is basically coming from B&K. So just wanted to understand, basically, is it sitting only in the mutual fund distribution business number?
Meaning? No, sorry, just to kind of clarify, I think the 18,000 crores of net flows is relevant to the mutual funds business. And the rest of it, the TBR, which is the custody stocks and so on and so forth, is not referred into this category. This is only for the ARR.
Only for the ARR. Okay. And so basically, how do we see the net flows for the entire financial year 26? I mean, you have given guidance around 35,000 odd crores. Do we stick to that?
No, I think we continue to be focused on our strategy of getting 12 to 15% of our net opening AUM as net flows for the year. We started out the year at around about 1,65,000, 1,70,000 crores of opening ARR AUM. So around about 12 to 15% of that is what we would focus on getting as net flows. And the quarter one has been quite robust in terms of flows. I think we've seen the asset management business do around about 1,000 odd crores of net flows. The wealth management business also had good flows. It was a little bit tempered with the 1,700 crores of flows because we had a little bit of net outflows also coming from the departure of two of our teams. And that kind of impacted the flows broadly by around about a 3.5 to 4,000 crore number for the quarter. This is the second quarter, I think, since the departure of the teams. We expect between the two teams, as pointed out earlier, around about 5 to 6% of the AUM to be lost. So 4,000 crores of the AUM, 3.5, 4,000 crores of net AUM is the outflow. And we've got another 1,700 crores of net flow. So overall, with the induction of new teams, you had a good quarter of 6,000 crores of net flows. On the wealth management side, sounds a little tempered for last quarter of being around 1,700 crores for that reason. In addition, asset management has seen around about 1,000 odd crores. And plus the B&K, that broadly kind of sums up the total of the net flow number.
Understood. Second question is on the ATM money. So basically, we have seen that this kind of business is kind of bleeding. But I suppose that we have got good plans for this in 26 as well as 27. It will be like net positive for us in the bottom line as well.
I think we made a lot of progress on ATM money. I think when we took on the business, it was kind of having a broad loss of around about 5 crores a quarter, 4.5 to 5 crores a quarter. We've got it down to nearly 6 crores, 5 crores a month. We've got it down, so now around about 50 to 60 crores annually. Now it's down to around about 6 to 7 crores a quarter. So I think over the last 8 to 9 months, the business has made significant progress. I think we've also decided and charted out a very clear growth map and strategy, which we are fairly confident about. And business from a moat perspective continues to have 3 phenomenal moats. I think having technology to execute at scale, B, having focused only on financial advisory and wealth management as opposed to going down the brokerage path. And thirdly, continues to be very, very rich in content and SIPs. So I think how do we kind of monetize that is something which we've been working on over the last 6 months. And simultaneously, we've been able to kind of get the burn down from around about 55, 60 crores a year to around about 25 crores.
Understood. So lastly, on the yields, I think we had a very good quarter in terms of yields as well. But I believe that, I mean, yield will go down, right, by 1 or 2 basis points, maybe within the next 2 to 3 years. I think is that a fair assumption?
So I think yield will go down by 2-3 basis points, but I'm quite confident, like I've said earlier, about the headline yields being maintained in different line items. But I think the mix of business will grow slightly differently. So I think distribution will continue at that 75, 80, 85 basis points, advisory at that ballpark range of 30, 35 basis points, and discretionary broadly at 40, 45 basis points. And NBFC at that broad 350, 400 basis points. But the contribution of each of these lines on a relative basis may change a bit. Advisory and discretionary might become slightly more in percentage terms than distribution. And therefore, effectively, that will cause a compression around about 2 to 3 basis points on the yield. So while the headline yield numbers might not change dramatically, I think overall on the wealth management ARR, we might see a little bit of compression of 2 to 3 basis points basis the mix of business. On the asset management side, so the only place where I see a little bit of reduction in the headline yield is on the asset management side on the listed piece. I think we built a fairly robust business of nearly 50,000 crores of AUM, and we've been able to maintain nearly 62 basis points of blended yield. And I think that's a place where I think as we incrementally add AUM relative to the mark to market, and the yields might come down by 3 to 4 basis points. On the alternate side, I think the yields will continue to be in that ballpark range of 85, 90 basis points to 95 basis points, including the carry income. So overall, I think on the asset management side, again, not a big compression yield, again, 2-3 basis points, but more coming out of the listed side than the alternate side. And then obviously it's a function of a little bit of the mix of the business. Obviously, if we grow a little bit faster on the alternate side, there won't be any reduction in yields. On the other side, if you grow faster on the listed side, there may be a little bit of reduction in the yields. So while I think if I just look at the 6-7 main pillars of business, I don't see a reduction on the headline yields, but a mix of the business will result in a reduction of 2 to 3 basis points.
Understood. So my last question is in terms of attrition. I think you have mentioned very categorically that, we have lost some bit of AUM, but I think we have kind of hired from the competition as well. And so the net impact should be kind of low, right? In the over the next 2 to 3 quarters, we would see some kind of a bump up in the AUM growth by hiring more from the competition.
Yeah. So I think I won't say there's no impact. There's always impact of change. Okay. I think that we have to recognize. And at the end of the day, we are in the people business and people are our biggest assets. Having said that, obviously a little bit of change and attrition is inevitable. And, as a firm for the last 15 years, we've been able to kind of really serve as a phenomenal platform for our people to grow. And I think we continue to work tirelessly 24/7 to ensure that we provide the best platform for all our employees to take to clients. And while we are able to match ambitions and aspirations of most of our people, sometimes some people have to kind of move on. And while we kind of respect that, we've been able to retain more than 90-95% of our entire senior sales force, resulting in a fairly solid AUM growth as well as a very low attrition number. It's the first time over the last 1 year we've seen some attrition, and that's obviously led to, as I said earlier, around about a 4 to 6% potential loss in AUM. Having said that, it's obviously opened up our eyes to all the talent which has kind of got built up in the industry over the last 10, 15, 20 years. I think there's a lot of good talent out there, and we've really worked hard over the last 6 odd months to be able to attract the best talent. And we've been very successful. We spend a lot of time in meeting people. A lot of at least 3 or 4 very large teams have already joined us, and we are at the cusp of potentially seeing 3-4 more large teams joining us over the next 3 to 6 months. So it's something which kind of little bit continues here and there. Left to choice, I wouldn't want a single person to go, and if possible, we could recruit the entire wealth management industry, but obviously can't happen. And broadly around that, I think I wouldn't say we would want to lose anybody, but we're in a comfortable position in terms of a little bit of plus and minus. It's a stop and a go, and that has its own kind of implications. But eventually, as you rightly pointed out, it becomes a bit of a rolling curve, and we should be able to add much more AUM than we potentially lose out of attrition in the short term.
Understood. Thanks and wish you all the best.
Thank you.
Thank you. Request you to kindly restrict yourself to 2 questions each. Next in line, we have Nitesh Jain. Nitesh, kindly unmute yourself and ask your question.
Hi, thanks for the opportunity.
Thank you, Nitesh.
I have 2-3 questions actually. So first question is net outflow that we are seeing of 3 to 4,000 crores. When do you think it will stabilize and neutralize in coming over next 2-3 quarters?
Nitesh, maybe if you can ask all 3 questions, it will make it easier for me to answer and maybe speeden up things a bit.
Yeah. There is also an increase in yields on the lending book and AIF in this quarter. So any particular reason? And third is if you can give some color on the transactional based revenue for the quarter in terms of breakup in direct equity, unlisted, BNK, and that would be useful.
Thank you. No, so I think to start off, I think obviously the impact of AUM moving out is slightly front-ended. I think that's I wouldn't say it's typically I would kind of split it between 2 to 3 quarters. I think a couple of quarters is gone. So in our own assessment, we are towards the second half of the last quarter of net outflows. From a perspective of being able to kind of predict it to perfection, obviously very difficult, but I think it's fair to say that large majority of it is already done. In terms of the quality of the transaction income, and then I'll come to the yields. The quality of the transaction income, obviously, I think we're working very hard to ensure that our transaction income is as close to being repetitive as possible, as opposed to being kind of cyclical. And as we do, work hard to grow our transaction income from around about 550-600 crores to around about 1,000 crores over the next 2-3 years. I think in that respect, I think building a very strong research-based equity brokerage platform for both institutional corporates, family offices, as well as ultra high net worth is very important. I think today that number for us, if I kind of add both BNK together with the ultra high net worth brokerage platform we have, is around about 270-280 crores. I think we hope to kind of build that and grow that by at least 20-25% every year for the next 3-4 years. In addition, obviously, we've got the other asset classes, including fixed income, debt, bonds, unlisted equities, a little bit of real estate insurance, which kind of gives us the ability to add the remaining 300-400 crores of transaction income. So overall, I think while I think transaction income has been super healthy over the last 3-4 years, I think our ability to diversify across asset classes and be able to toggle across multiple client segments will allow us to kind of grow that in a responsible way. And we continue to work very hard to ensure that our transaction income can be on a steady state basis around about the 250 crore number on a quarter-on-quarter basis over the next 2-3 years. And while we build that, we are also kind of very conscious of the fact that we would like to maintain our transaction brokerage income at around about 20% of our total income. So I think that's the broad principle on the transaction brokerage side. In terms of the increase on the yields on the AIF and lending, obviously the lending has a little bit of an impact of the increase on yields on account of the capital raise last quarter, and that obviously kind of will come back and from a compression of yield perspective as the book kind of builds up. On the AIF side, yields have been kind of fairly steady, nothing super phenomenal, just a mix of assets. I think a little bit more increase in yields, largely on account of the larger amount of commitments coming in on the alternate side. So I think the drawdowns have kind of started coming in, and that's kind of increased the yield a little bit.
Sure. Just one follow up on TBR. What is the revenue from NSE, etc. in this quarter? NSE transaction.
We don't really disclose revenue on a transaction by transaction basis, but there's nothing lumpy from an NSE or any of these. So there's nothing lumpy from a TBR perspective. I think there's no single transaction which contributes more than 10-12% of our TBR revenue.
Sure. Thank you. That's it for myself.
Thank you. Next in line, we have Prayesh Jain. Prayesh, can you unmute yourself?
Yeah, hi Karan.
Hi Prayesh, how are you?
I'm good, how are you?
All well.
Just on this outflow on the lending book, what was the reason for that?
Nothing specific, honestly. I think lending book will come back this quarter. We had a couple of large loans against a few collaterals got refinanced at slightly lower rates. I think that's about it. And the loan book is steady. I think we have our own space in it, and very quickly I think it'll come back to its own base.
And on the retention on the lending book, do you think that we would be back to something like 5.3 odd levels, what we used to
maybe
kind of
4.7, 4.8 to 5-ish. We've also kind of come off of a cycle where we were borrowing a little bit more expensive. I think that's also come off for us a bit. We are able to borrow at substantially better rates now.
Okay.
And I think we also have kind of ended up raising a bit of capital. So I think overall feel comfortable with that number. In the shorter end, obviously a little bit of compression, but I think it may not be 5.3, but definitely around that 4.8 to 5% ballpark.
Okay. And last question, BNK and UBS numbers would start getting reflected from 2Q onwards?
So BNK is reflected for 1 month, I think 35 days. So that
Okay.
that will start getting reflected from the second quarter fully. UBS numbers, I think we've kind of got all the approvals in over the last 2-3 days. So I think there are certain other CPs to complete the transaction, which in natural course will take another month or so. So I think effectively UBS not maybe this quarter, but the next quarter. BNK fully in this quarter.
But BNK entirely would be in transaction in this quarter, or is there anything else also?
So there are two elements of income.
Corporate treasury distribution.
Yeah, corporate treasury. So corporate treasury is also kind of has, again, small two elements. It has an element of ARR, which is on the mutual fund side.
Right.
And there's a very small amount of bond brokerage also.
Okay.
But I think BNK on the ARR side, out of its total revenue would be adding around about 20-25% of ARR revenue of its total revenue.
Okay, got it. Thank you so much and wish you all the best.
Thank you. Next in line, we have Sanket Goda. Sanket, kindly unmute and ask your question.
Thank you for the opportunity. Karan, you said that 1750 crore is the actual flow happened in the current quarter, and you said 12 to 15%, which translates into 20 to 25,000 crores for the full year. So when you said 20 to 25,000 crore, it is like to like 1750, right? That's the way I need to see wealth ARR net flows to play out in the current year.
No, so as I said earlier, I think 1,65,000, 1,70,000 into 12 to 15% would be 20 to 25,000 crores on the wealth management side. We opened the year at around about 75-80,000 crores on the asset management side. So take another 12 to 15% of that, which is effectively 9 to 12,000 crores. So you add the two, you effectively end up at around about 27-28,000 crores to 34-35,000 crores. So that's the sum total of the ARR AUM we aim to target. On the wealth management side, therefore, we need around about 5,500 crores on a quarterly basis, on a run rate basis, net flows. I think, as I was explaining earlier, I think we did on a normal course basis around about 6,000 crores in net flows this quarter, 6,500. It's kind of got partially set off with gross net outflows of I don't want to call it exceptional, but 3,500-4,000 crores of net outflows with two teams kind of moving out. And I think that stays max for another quarter, but we hopefully quarter 2, quarter 3, quarter 4, we do enough to be able to make up the 7,000-8,000 crores of incremental net outflows which happen thanks to the hiring we've done. So I think that's really where it is. I think if we started out aiming to collect 20-25,000 crores on the wealth management side, like I'm saying, we have to do 7,000-8,000 crores extra for the year. So we have to do 27,000, 28,000 to 35,000 to account for the 8,000 crores of net outflows.
Perfect. This explains. And the other one we just wanted to check is that out of that 150 crores of transaction income, what you reported in the current quarter, how much would be BNK? That's one thing. And also in the employee cost of 180 odd crores, how much would be BNK related employee cost? Just to understand the color.
So we are not reporting entity wise, we are reporting segment wise. Okay, so I think BNK largely gets reflected in the corporate and institutional bucket, which is effectively around about 24 crores for the previous quarter.
Okay, that's it from my side. Thank you very much.
But 24 crores is 35 days. Yeah.
Next in line, we have Abhijit Sakare. Abhijit, kindly unmute and ask your question.
Hey, I hope you can hear me. Hi,
yeah, hi Abhijit, I can hear you.
Yes, okay. So first question is, when I look at the TL team, the TL base that we have, it seems like there's been a bit of a juniorization over the past 12-18 months. So how do you think about that in terms of ability to sort of gather large mandates? I'm guessing some of it is because of the exits that we've seen. So the 5-year plus vintage data that we disclose, that's come off a little bit over the 12 months. So I mean, there's obviously a very severe intensity to go for good quality talent, but
yeah, Abhijit, that'll change in 6-8 months with the recruitments. Yeah. So it's not really kind of a permanent change or something. Obviously, with the loss of 8-10 bankers is showing up a little bit, but as soon as we do the recruitment and everybody comes in, that will change automatically.
Okay, got it. And then just in terms of the AUM that moves out with these exits, is it fair to say that the distribution assets have a higher tendency to move out compared to the advisory, or there's really nothing across the segments when large teams move out?
No, I think it's fair to say distribution assets will have a slightly more tendency to move out, followed by advisory and the discretionary being the least, because obviously the interface of the firm is different in all the three mandates. Having said that, I think broadly speaking, that number is, in my mind, any number between 5 to 6%. I would be really surprised if it's a number dramatically higher than that. After that, obviously, the challenge, the battle, the opportunity is really to engage with the client and then kind of there's business as usual. So I think from an AUM perspective, I still don't have data rich enough to say that on distribution it is 7 and on advisory it is 4. But I think logically speaking, you're right. I think distribution assets are more likely to kind of get attrition faster. But I think broadly speaking, if you can, if the numbers stay around that 5 to 6% a broad benchmark, I think that would be healthy.
Got it. That's all. Thank you so much.
Thank you, Abhijit.
Thank you. Next in line, we have Siddharth. Siddharth, kindly unmute and ask your question.
Hi, thanks. Thanks for the opportunity. 2 questions from my side. First up, is it possible, given this whole attrition piece, for you to share the gross flows both on the wealth and the asset management side for the last 5 quarters? And the second one was to understand what was the institutional mandate addition net of the addition that may have come from BNK. Specifically on that, if you could also additionally give an outlook on the asset management side on credit and private equity flows, which tend to be relatively higher yield. The last is an accounting question. Have we moved from accrual accounting on carry income? Because there seems to be a quarter-on-quarter variance. Last quarter, there was that carry income. So have we moved back from accrual, or is that due to a difference in performance resulting in lower carry? Yeah, those were my questions.
I'll start with the second one first. There's no real change in the accounting of carry. It still continues to be on the same method. It's not a pure accrual method. It's slightly more conservative than that. The way we work on carry is we estimate the carry basis the NAV, and then once the funds are only 18 months away from maturity, that's the first time we start recognizing carry. And then we kind of distribute it over the 6 quarters, reaching towards the conclusion of the fund. So typically, if a fund is ending towards the closure, that's really when you'll see the carry fluctuate a bit. But outside of that, there's really no, I wouldn't call it's like on accrual. It's a conservative method of kind of computing carry. It becomes calculable for carry only once the scheme is 18 months away. Specific to your question about carry from the last quarter to this quarter, I think we have a couple of institutional mandates where we charge carry once a year at the end of the year. And there was a $5 million, 40 crore rupees carry, which we had kind of given out as a footnote last quarter, which was booked out as carry in the previous as performance fee in the last quarter. So that's what is causing the variation. But outside of that, our normal carry calculation on our alternates is more or less in a kind of a straight line, unless and until there's an entry of a big fund into the 18-month kind of category. On your first question, in terms of net flows itself, I think, like I said, broadly, I think very, very broadly, without going into specific gross flow, net flow numbers for every quarter, I think generally speaking, in every quarter, there are outflows around about anywhere from 800 to 1,000 crores. There would be net flows of around about 4,500-5,000 crores. That would be target. Gross flows of 4,500-5,000 crores, and leading to net flows of 4,000 to 5,000 crores. So that's the broad number. I think, as I pointed out in the last 2 quarters, I think the net flows have been slightly better. Instead of 4,500-5,000, gross flows have been slightly better. Instead of 4,500-5,000, have been closer to the 6,000 odd crore number. the net outflows, the gross outflows have been slightly higher. Instead of being 1,000-1,500, have been 3,500-4,000, which has resulted in the net flows of 1,500-2,000. So overall, I think broadly, if you want to kind of reach the gross flows number on a steady state basis, add around about 1,000-1,500 crores for net outflows. For the last 2 quarters, that net outflow instead of being 1,000-1,500 is 3,500-4,000. So that's the broad color on the flow number. As far as the asset management goes, no special mention of any flow specific to the last quarter. Is business as usual. I think we closed out a couple of new funds last quarter, especially we closed out the healthcare fund of 1,000 crores. Our pre-IPO fund, which had got kind of closed out 2 quarters back at 4,500-5,000 crores. I think that on that we charge fee on a drawn down basis. So effectively, the AUM keeps increasing as we kind of call for capital. And we continue to be focused on trying to do one strategy-based alternate scheme pretty much every quarter. And I think as time goes by, both on the private equity side as well as on the listed side, as well as on the real assets and the pre-IPO side, we'll see we'll potentially see a fund close every quarter and maybe 4 or 5 funds through the year. So nothing specific on the AIF or the alternates or the listed equity side for the last quarter. I think business as usual. And we'll potentially, to reach our target of 8,000-10,000 crores, we need 4 or 5 new funds, and potentially the calling for the drawdown of the funds which we've already raised will lead us to the 8,000-10,000 crore number.
Thank you.
Thank you. Just one part that got missed on the institutional mandates. Was there any addition that came in from the institutional mandates that are there with B&K, or are these flows completely organic?
On the asset management side, they're completely organic.
Okay. Thank you. Thanks, Karan.
Thank you. May I remind you, in case you wish to ask your questions, please click on the raise hand icon. Next in line, we have Dipanjan Ghosh. Dipanjan, kindly unmute yourself and ask your question.
Hey, hi, Karan. Good evening.
Hi, how are you?
All good. Just few questions. So first, again, I mean, presentation, the corporate and institutional segment, if I presume that majority of it is B&K, it seems that the run rate of, or maybe 35 days is like a month. So let's say the monthly run rate, if I were to annualize it, it seems that B&K is broadly flattish to maybe a little bit better than last year run rate, both in terms of revenues and maybe PBT. So firstly, is that a fair assumption? And secondly, I mean, going into the year, probably we were expecting B&K's revenue, given a high base, probably to be a little bit tapered down. So how are you looking into it? So that's the first question. Second, obviously, during the start of the call, you mentioned that the institutional mandate pipeline is holding up. So, out of the flow expectation that you've mentioned for the year, what sort of quantum are you building from this institutional mandates? And last question, in terms of the new hiring that you're doing on the team leadership side. So obviously, you have on one hand seen attrition of flows from your clientele because of, RMs leaving the organization. On the flip side, you are doing a significant amount of lateral hiring. So what sort of flows do you expect because of this lateral hiring, and what can be the associated cost that goes into the P&L because of this?
Okay, sorry, I'm just looking at, So I think B&K is not flattish. It's actually done slightly better. I think over the last year in question, I think it was around about 16-17 crores a month, which we had disclosed last quarter. So leading to around about 204-205 crores. I think for the current quarter, it's around about, give or take, 16-17 crores a month, leading to 200 crores. I think the current quarter, it's around about closer to the 21 odd crores kind of number. 21 odd crores for the month. So effectively, it's closer to the 250-260 crore number. So broadly, seems like all things being equal, a 15 to 20% higher number than last year, which effectively from a PBT perspective will translate to a 10 to 14% higher PBT, all things being equal for the next 4 quarters. So I think BNK is around about 20-25% growth. Coming to your question on the institutional mandate, we really don't end up building in something specific for our net flows number. I think we have to get to the net flow number, whether we get an institutional mandate or not. But I think we are always in touch on the institutional mandate side. And, typically cycle for institutional mandates are fairly long. We've got 5 of them as we speak today. And it would not be fair to expect at least one of them coming through the course of the financial year. On the team hiring, obviously it adds to the cost, but I think our existing team was also extremely well compensated. So I think it's really in that sense for the current year at least it's a difference. It's not really the sum total of both. So I think the cost pretty much like earlier is part of the entire cycle. I don't expect it to disturb our cost to income ratios in any material way, unless we do decide to hire more people for growth. I think on a steady state basis, just the churn of the team members itself doesn't lead to a cost addition.
So just one follow-up question, Karan. I mean, the cost for the global offshore team, is there anything during this quarter or is it completely
No, it's there in the last quarter. It won't be there from this quarter.
Got it. Thank you and all the best.
So for the last quarter, 8 to 9 crores of cost would be there. Yeah.
Got it. Thank you.
14-15, sorry. So last quarter, around about 14-15 crores of cost would be there from the global team, which won't be there in this quarter. Yeah.
Okay, sure. Thank you, Karan, and the team, and all the best.
Thank you.
Next in line, we have Lalit Dio. Lalit, kindly unmute yourself. Lalit, kindly unmute yourself and ask your question. Siddharth, in case you wish to ask a question, kindly unmute yourself and ask your question.
Hi, thanks for the follow-up opportunity. Just wanted to understand on the lending book, you mentioned that there was a specific reason for that sharp fall. How should we look at that going forward? Also, just a clarification on the overall net flows that we are looking at, right? Including the 26,000 crore that we would expect from the UBS acquisition and the 18,000 crore that came from BNK, broadly 70 to 80,000 crore addition in the ARR AUM. Is that a fair way to look at it?
No, I think the UBS ARR AUM substantially lower. It's not 26,000 crores. The entire AUM of UBS is 26,000 crores, not the ARR AUM.
Okay.
And the 18,000 crores of BNK is fine, and we'll definitely aim to hit our 35,000 crore number. So I think all put together, 55,000 crores, and UBS will be a sub 10,000 crore number purely in terms of ARR AUM. So I think that's the math. So I think all three put together will be between the 60 to 65,000 crores.
Sure. And if you could clarify on the lending book, that fall of 1,000 crores.
Nothing out of the ordinary of the lending book. I think it moved up sharply in the last quarter also in Q4. At Q3 and Q4, there were 2 short-term loans which kind of got repaid. There's nothing else really from a lending book perspective. And there were low loans of Q3, Q4 which kind of got repaid. And our current quarter has seen a good uptick back in the loan book. So nothing really specific on the loan book itself.
Got it. And one more on the HNI. So this quarter we've seen net flows of roughly around 1,500 crore, 1,100 crore of which seem to come from HNI. So is it fair to say that the ultra HNI book was pretty much all outflows being replaced by gross flows, and the entire net flow is, or large part of the net flow is coming from the HNI book?
Out of the 1100 crores of AUM and HNI, around about 500 is
Organic.
Yeah, 500 is organic, and 500 is from BNK.
Got it.
So
Thanks.
basically
This is very
1200,
useful.
if you take out the 500 crores of net flows from HNI, the 1700 crores will become 1200 crores.
Got it. Got it. Thank you.
In case there are any more questions, you could click on the raise hand icon. Dipanjan, you have a question?
Hey, hi, Karan. Just one follow-up. Now that the UBS kind of tie-up is broadly going to probably kind of kick in the next maybe quarter or two. Just wanted to understand the thought process, when you have worked with the UBS team in terms of identifying the potential customer cohorts that you can tap into, or, in terms of how the ecosystem will work, or, some sort of color that, for us, investors or sell side, for us to understand what sort of an addressable market, that in your mind you think could be a potential, AUM accretion, possible that from this cohort, let's say over the next 3-5 years out there, any sort of broader color on that?
So I think, to be honest, we've not gone into defining exact specific numbers. I think we are clear on the 5 points of collaboration, and I think that's really where we would like to keep it. I think UBS is also a very, very large engine, a lot of areas to work for and understand. We've obviously also got our own style and working operations. And I think first is for the transaction to close, then we get into the collaboration agreements, which itself will take, let's say, a month, a couple of months to get done. But I'm quite confident directionally the 4 or 5 things will play out very well. I think it's too early to define a quantum, but I'll kind of re-emphasize the 4 or 5 collaboration points. I think the first collaboration point obviously is our ability to kind of feed into the UBS global products for the resident Indian LRS and GIFT City money. Second, obviously, is for our asset management products to come onto the to the UBS wealth management platform, and their ability to offer it to all their wealth managers to kind of feed into our products in India. Obviously, that itself also needs to go through the same product approval committees like it would need for it to go through our side. Thirdly, obviously, is your clients who've kind of Indian clients who've kind of moved out or have built a very large LRS portfolio over a period of time, effectively kind of referring them to UBS for the global wealth management relationship. And fourth, obviously, is UBS kind of referring us to global NRIs who have an Indian resident NRO NRE portfolio which is still in India. So I think these 4 are the main pillars of collaboration. And fifth, obviously, our ability to kind of draw benefit out of learnings from each other on way of doing business, how do the large global ultra high net worth get serviced, and so on and so forth. So I think the first 4 obviously will get quantified, will lead to a certain number. Is it a certain target in our mind today? I think the answer is no. I think our first target really is to get all our products approved on each other's platforms and kind of build the right alignment of interest and show it to relationship managers on both the platforms. And I think once that is done, I think honestly, the India story as well as the ability of people from India in a limited way to diversify their assets are both existent. So no reason to believe why we can't see a certain percentage of the India AUM move into GIFT City, and similarly a certain percentage of the entire global AUM on the UBS wealth side move into India as a country. Too early to decide what that AUM percentage might be. Could be 1%, 2%, or maybe potentially 4 or 5% from here. But that's something which time will tell, and obviously a lot of it will be in the execution of it.
Got it, Karan. And thanks for the elaborate clarification.
Thank you.
Thank you. Thank you. That's all we have time for this evening. Thank you for joining us on this conference call. Have a nice evening.
Thank you, everybody. Thank you.